Hi friends, very good evening. In today's video, I will be talking briefly about financial planning. In fact, every day we hear this word, so I would be covering in detail about various aspects of financial planning. But before that, please note that this is a free educational video purely for the purpose of learning. This should in no manner be considered as any kind of advice, offer, or promotion to sell anything. Okay, now firstly, let's understand what we mean by financial planning. And before we do that, I would want you to think quickly in your mind what comes in your mind when you think about financial planning. Okay, now I'm giving you 2 3 seconds to think. All right. So basically, what really comes in the mind of a person is basically one thinks about savings, how to invest, where to invest, no money to invest, tax planning, or even some people think no savings. But actually, these are some of the very important things which comes to one's mind when one is trying to think about financial planning. So quickly, I would like to break a couple of myths which are there and proceed with that. So the first myth which is there is the fact that we often think that we don't have enough money or savings. But if you really think about it, that if one were to invest from one's leakages or expenses or whatever expenditures which could be plugged and save about 5,000 rupees a month and put that money into any good mutual fund scheme, uh, like for example an equity mutual fund SIP, and assuming that earns 12% rate of interest. Of course, this is for assumption and illustration purpose, and past returns are no guarantee for future returns. And for 25 years, one could end up making approximately 1 crore rupees. So, isn't that a great tool to save? Think about it. Okay, so basically, what we are doing when we talk about financial planning is we have to clearly follow certain steps. Number one is goal planning, then the cash flow or the money, then we have to make a proper plan or an investment plan, and then we have to talk about the risk or return and what exactly is my risk profile as an investor, so that the person or the investor has to think. And last but not the least is tax planning. Unfortunately, as an investor, we start with tax planning and then go and think about other investment avenues. But according to me, tax planning should be at the end after we think all these four steps which I have already told. Okay, now let's move forward. Now, before we do that, one has to basically understand at what stage of life is at the current person. If you're in your 20s or mid 30s or in early 40s, 50s or 60s, that would change the entire dynamics. So, firstly, decide what stage of life cycle you are. Okay, then decide and clearly demarcate your goals. Now, goals have to be smart. What we mean by that, they should be specific, measurable, achievable, realistic, and time bound. Okay, and you have to make your goals very clear, like short term goals, less than 1 year, medium term goals, 3 to 5 years, long term goals, more than 5 years, depending upon the investment horizon that you have. Then you have to follow the next step, which I have told you, cash flow. That means the money. The money that you would need to meet all these goals, depending upon the goal, short term, medium term, or long term. And you have to make a proper cash flow. That means how much income or expenditure I have, and try to plug the wasteful expenditure and create a budget. Okay. Then you make a proper investment plan. So basically, once you do this, you have to keep in mind while making a proper investment plan certain important concepts like inflation. Inflation means the rise in prices of things, which is a negative thing. Then the positive things like power of compounding and asset allocation, which is dividing the money effectively into various asset buckets. So these important concepts are to be kept in mind while making an investment plan. Okay, now we move to the next thing. That means what are the important investment avenues which are available to a customer? For example, what comes to my mind is you have equity stocks, you have bonds, you have fixed deposits, you have PPF, you have employee provident fund, you have mutual funds, you have property, you have jewelry. So it would be very difficult to decide for an investor uh, without doing his proper risk profile. Now, what I mean by that is if you are a risk averse, that means you get scared by the volatility in the market, then obviously equity is not the right asset class for you. There are various options and debts which the investors could look at. But the joke in equity, which is there, is that if you invest in equity, and this is a very interesting joke. How do I make 1 crore in equity? Well, you start with 2 crores. So exactly that's what I'm trying to say. That if you put money in equity and you have no idea about stocks, you end up being a loser in the equity market. So do your research, do your homework, and if you don't know, the best way to enter equity or a safer way is through equity mutual funds. Okay, then another asset class which is less talked about is bonds. Now, basically, bonds are like fixed deposits giving you payout, but obviously a different category. Only in terms of the nature that they give you a regular payout and comparing a fixed deposit. Actually, bonds are very different from fixed deposits overall, but they pay you regular income and you get your money on maturity. Now, why bonds are appealing? Because obviously there are a couple of bonds which are very safe, like government bonds, sovereign bonds, RBI bonds, so which may be considered by an investor depending upon his risk profile. For example, a conservative customer could look at that. Then you have private sector bonds, perpetual bonds, deep discount bonds. Obviously, you can do your research depending upon what exactly is your requirement. Okay. Now, basically, uh, the whole idea is whatever money you have, you should make a plan and sit with a pen and paper and decide how much return I'm getting in each asset class and how much I would be making at the end of the period. While doing that, do keep in mind how much coupon, that means return I'm getting, or interest payment, which is annual or half yearly, what is the lock in, what are the terms and conditions. For example, corporate fixed deposits are also getting a lot of attention these days. But what exactly we need to know? What are the premature withdrawal conditions and other things? So basically, keeping all these things in mind, one may get into different asset classes depending upon the risk profile. Then there are certain government schemes also which investors may need to keep in mind, like PPF, Sukanya Samriddhi Yojana, National Savings Certificate, Senior Citizen Savings Schemes. Depending upon what is your investment horizon, you can do a Google and find about these schemes. These are also attractive investment avenues. And then, of course, there are alternative assets like real estate, which is famous across from people as an alternative. You have REITs, AIFs, PMS. So obviously, ticket size may be higher in this, and not every investor may fit into this bucket. And then mutual funds obviously are there, which are equity, debt, and then hybrid, which is a mix of equity and debt. Okay. Now, while investing in mutual funds, do keep in mind what is your objective. Whether you are able to invest in one go, or whether you can do in parts like an SIP, or whether you would want a regular payout. So after few years, you want a withdrawal. So you have an SWP option. So that also you can think in mutual funds. So, coming to the point, while deciding all of this, you need to keep in mind your risk and return. And equities are more riskier, and debt carries relatively lower risk. Of course, you need to study and do everything according to your risk profile. And past returns are no guarantee of future returns. You have to do your homework diligently. Okay. Now, obviously, in my earlier videos, I've also talked about tax planning. So you need to do tax planning about various asset classes, mutual funds. You need to be aware about capital gains. You need to understand the tax on your equity shares, debt mutual funds, bonds, while getting into decision. In my earlier video, I had shared about the new mutual fund tax implications from 1st April. So kindly watch that video in case you have any queries. So that would greatly help you in understanding the new mutual fund taxation from 1st April 2023. Okay, now apart from this, there are certain other tax benefits while doing your financial planning. Various sections under Section 80 which are available to individual. Like 80C, we all know 1,50,000. Then obviously you have new pension scheme 80CCD 1B, interest income from savings account, and then you have Mediclaim 80D, then you have donations you can do under Section 80G. So read about them. And then obviously in mutual funds you also have tax saving mutual funds like ELSS, or there's a lock-in for 3 years in these kinds of mutual funds, which are also as another alternative to tax saving and giving you benefit under Section 80C. And obviously, last but not the least, a point which people don't talk much is need based insurance. So, check your need. And why insurance? It's not required for everybody. If you are rich and HNI and you have assets, you may not need insurance. But for people who are not in that bracket and who want to maintain that lifestyle for say, self and family, insurance may be needed, like a term plan or a health care plan. So the bottom line is don't mix investments with insurance. Okay, so broadly to conclude, you have to basically plan, save, and invest wisely. Start early. Equity is long term wealth creation. Basic knowledge is enough in financial planning. Too much GAN is not really needed. Small investments done regularly can make great future fortunes. Power of compounding is great. Asset allocation, right approach, and choose the right set of tax efficient instruments. Thank you very much, and I hope you like this video. Do take care. Thank you.